I've made an instructional sheet on how I would approach this model. So I'll start walking through the instructional sheet. But I'm on the navigation page right now, which just shows the high level of everything that's included in the model. So before I go through the instructional sheet, I'll kind of go through the navigation sheet and tell you just very generally what's included in the model. So the first tab is an investment summary. It's a cut sheet of the major deal points. It's a 1 to 2 page cut sheet, depending on what aspects you want to use, that just gives a really great quantitative and qualitative look at the deal that you can print out and give to your investors or to your lenders. It's good for talking. The command center main inputs is where all of the major operational and financing assumptions are housed. The renovation support sheet, which is tab 3, and the calc renovation schedule, which is tab 11. This model, I've enabled it to where you can either look at a stabilized multifamily deal, you could look at a multifamily deal in lease-up, or you could look at a deal that needs major renovations or light renovations. If you are looking at a deal that needs renovations, I've enabled it to where you can scope those renovations by building, or you can scope those renovations by floor plan. So scoping renovations by building, that is going to be on the sources and uses tab, and I'll show that here. And then the renovation support sheet and the calc renovation schedule, that's for scoping renovations by floor plan. Different sponsors like to do it different ways. A lot have requested the scoping by building to be able to just get a high level, quick and dirty look at what a renovation scenario would look like. And then they like having the scoping by floor plan to get into the details later. Calc investment cash flows is really the engine of the model. So this model is a monthly cash flow model that rolls up into annual cash flows. And I show both the annual and the monthly in nominal terms and per unit terms. Sources and uses is going to be your closing budget. It's all capital that has been raised at closing, which can include that broad stroke renovation analysis by building. Unit mix, this will give you your in-place unit mix and rents versus your year one pro forma. Equity waterfall are the cash flow distributions between the GP and the LP. Currently, I just have this set up as one GP bucket and one LP bucket. I'm going to include an additional module later, an optional additional module that can split out the GP into co-GP and then split out the LP into multiple share classes. But for most people, the single bucket for each entity is usually good. Yeah, if anyone is in the ever in the waiting room and anyone can let them in, that's great. Comp analysis. This is a place to put your sales and rent comps as well as the development pipeline. This model, I've also included a T12 deposit and a rent roll deposit. And the reason that I've done this is if you've ever gone and tried to analyze a deal, one of the things that can take a lot of time is sifting through a T12 and sifting through a rent roll and trying to standardize their labels and even the values into your model. And so I've included these deposit tabs as a way to automate a lot of that process. So it saves a few hours, and I'll show kind of how that works. And then the last tab is the calc financing tab, which is really a debt waterfall, which shows the timing of the funding, the payoff, and the payments of the loans that are included in this model. So that is high level, everything that's included in this model. It sounds like a lot because it's intended to be sophisticated, but once you get into it and once you kind of put your standard assumptions into it, it enables you to quickly screen deals between 15 minutes to an hour, just depending on what kind of deals you're looking at and how comfortable you can get with it. And I want to reassure people that, again, if you do purchase the model, that I'm always available for support. I'm always happy to talk through specifics about it and available to be a resource. So now that I've shared sort of the high level what's included in the model, I'll go over to my instruction sheet and share how I would go about underwriting a deal using this model. So some general guidelines to start. Anything that's a black font is a formula. Anything that's a blue font is an input. Anything that's a gold font is an optional input. It's currently linked somewhere else in the model, but you can change this cell to affect other areas in the model. And the reason that I've done that is specifically for things like market rent. It's currently linked to the unit mix, where you detail what the market rent is by floor plan. But if you're just trying to get a really high level look at the opportunity of the deal, and you're just trying to plug in an average market rent, you can just change this one input cell, and it'll change your weighted average market rent instead of having to go by floor plan. The green font is just a reference to another sheet. So how to start? So I would start on the Command Center Main Inputs tab, and I would name the property, do the the year it was built, the last year it was remodeled, etc. So if you're on the navigation page, you can click here and go to Command Center Main Inputs, and it'll take you to this tab. So the reason I like to start with really generic information like this, it's actually something I think that gets passed over a lot, is because if you look at the current name of the apartment community, if it's not something that really ties into the local culture of the area, or it doesn't have much to do with anything that's I guess important to the local people. It's not branded in a specific way. That might give a clue to the potential opportunity. Not always, but it's something interesting to look at. Year built is a lot more relevant. If you're looking at something that was built in the 1950s, odds are it's going to have a lot of exterior and interior renovations that it needs to have done. It might need significant overhaul. And the year that it was built can be a clue. The last year that it was renovated can also be a clue. I like to put multiple years of renovations if those are available, right? If this thing was built in 1950, but it's been remodeled in 2000, 2007, 2010, 15, 20, it's been remodeled several times. It's probably a clue that a bunch of value add plans have been implemented, so there might not be a lot of meat on the bone. So looking at those three things can already help you screen a deal. So after I start there, then I would go to the rent roll and T12 deposits, and I would make those deposits. So I'd come back to my navigation page, and I'd go to the rent roll deposit first, probably. So the rent roll deposit page, what this is, the building and the unit number, those are helpful references, but they don't really link anywhere in the model. It's really just a reference on building number and unit number. The unit type is what maps back to your unit mix in the model. So I'm still really working on perfecting this mapping. What it does right now is it just takes the left two characters in this unit type, and it maps those back to standardized floor plans in your unit mix. But as you know, every operator is going to name their units something different. So you still could use this mapping system. You would just have to make sure that your mapping system aligns with what's going on in this unit type. And that's easy enough to change in the unit mix tab. So yeah, drop in unit type here, square footage here, unit status here. Usually a rent roll is going to say something to the effect of, this is a model unit, this unit is occupied, this unit is vacant, etc. If it says occupied, it's going to tell your unit mix that this unit is occupied, and that'll give you your in-place occupancy. Market rent is really just a subjective metric. That's what the current owner is asking for rents. So sometimes owners' rent rolls will have a market rent on there. Oftentimes they don't. If they don't, you can just leave this blank. It's no problem. You're going to decide what you think the market rents are anyway. Charge codes. So rent speaks to the base rent of a property, which we'll see in the unit mix in a second. And then rent amenity. On larger properties, you'll see this amenity rent charge code that speaks to, maybe the ground floor units have a ground floor premium, or the third floor or 10th floor units have a view premium, et cetera. And that'll usually show up as an amenity premium, which gets which gets taken through into the unit mix as well. Lease start and lease end helps to calculate the average in-place lease term. This will calculate the in-place lease term, but I'm going to add an update into the model later where you can toggle the lease term. And what this does is it controls unit turnover, which controls absorption and turnover vacancy, as well as the timing of marking under market units to market. I try to get really accurate on the operation side, whereas a lot of models, make general assumptions based on percentages that are just kind of random inputs. This model really tries to tie the projected cash flows to projected performance. So average lease term is one of those things. So that is the rent roll deposit, and you'll see on the unit mix, after you've made this rent roll deposit, there's a lot going on this tab, but I'll start on the in-place rent roll. The in-place rent roll is taking from that rent roll deposit and automatically showing, hey, we have 36 A1 units at this property. We have 24 A4 units at this property. Of those 24 A4 units, there's 10 of those that are occupied. Of those A4 units, the average net square footage is 885 square feet, etc. And then it'll also show the in-place base rent. So if you've ever had the pleasure of coming through a rent roll, you know how long this process can take to do manually. And so this model accomplishes all of that automatically. So all of that information about your floor plans synthesizes here down below to show you your 1-bedroom, 2-bedroom, and 3-bedroom unit count, occupancy, square footage, base rent, and full rent. Full rent is just a combination of base rent and those amenity premiums we talked about. Then what I've done is I really tried to show how an operator is bridging the gap between the in-place blended rent per unit per month and the pro forma. So I've included a place for the untrended market rent roll for non-renovated units. So this is going to be the market rent, assuming that there is a mark-to-market opportunity without having to do any renovations. And then this unit mix over here is going to be the market rent for units that are going to be renovated. So assuming that there is some delta between the market rent for the units as they are without doing any renovations versus those same units if you renovated them, then that's what this unit mix over here is going to be, and that's going to generate your renovation premium. So all of that information is then summarized here up above in this little box over here. In-place rent, untrended market rent for non-renovated units, and untrended market rent for renovated units. This little checker right here is some operators just like to have a blanket statement of, can you increase rents more than 25%? If you increase or if you execute your business plan. Maybe some operators want it to be 35%, et cetera. So it'll be a yes/no checker for whatever you want to do. So that is the rent roll deposit, which synthesizes into the unit mix. Next, what I would do is I would come into the T12 deposit. And again, just a disclaimer, all the information in this model, like all the data that's dropped into here, are completely made up numbers. They don't have anything to do with any particular property, so don't take any stock in them. Especially if you saw numbers like these where the numbers are flat month over month, these are fake numbers. But what this does is you would drop in the most recent T12 that you had received, and then you would come over here to the mapping side, and you would say, okay, I've got gross potential rent over here. I have a drop down of the standard labels included in the model that you can then map these items to. So gross potential rent for the unrenovated units, gain or loss to lease, general vacancy, collection loss, retail income, storage income, et cetera. So all of your operating revenues and all of your operating expenses. So this drop right here can go pretty far down before it gets to your name map, which is pulling from your model, and it's mapping it month over month and then giving you your T12. And then all of this T12 pulls into your calculations investment cash flows. And it synthesizes that T12 here. But what this allows you to do is it allows you to take a look at what the T12 is relative to what your pro forma is assumed to be. So after I've dropped in the rent roll and the T12, I would, like we did, go verify that the unit mix has been uploaded correctly and that the information is correct on the unit mix tab. Then I would go and take a look at rent, sales, and rent and sales comps, and then the development pipeline. The reason I add the development pipeline in there, I think it's missed a lot on acquisitions, is, and I've added some flexibility on the calculations for this reason. If you know that there's going to be quite a bit of supply coming in 2 to 3 years from now, one, you want to know what the competitive set is today, which is your rent comps. But then two, you want to know what your future competitive set is probably going to look like. And if there's a bunch of supply coming online, relative to the expected demand, then you might want to plug in some concessions for future years that otherwise probably wouldn't be included in a standardized model. So I like to take a look at that. And then I've added a toggle onto the investment cash flows that allows you to change concessions in any given year, depending on that future supply and demand dynamic. So I think it allows you to make a more accurate projection than you might otherwise be able to. So once I've taken a look at the rent and sales comps and the development pipeline, then I would go and update the rents on the Unimix tab. If you don't have a rent roll, then you could go to the Unimix tab and plug in place rents based on whatever information the broker has given you, or whatever you can find from the operator's website, or just a conservative assumption based on surrounding rent comps and whatnot. Then you would do your market renovations for the non-renovated, or sorry, the market rents for the non-renovated units, and then the market rents for the renovated units. So that's going to give you your mark-to-market opportunity and your renovation premium. Then, after I've updated rents on the unit mix, I would come back to the command center, and I'd make my way through the various operating, financing, and exit assumptions. So, starting here, a lot of people like to start with purchase price. I think it's fine to put in whatever the whisper price is from the broker or from the seller. But to me, the purchase price is really a residual input. It's whatever the realistic projections can support. So, I would probably come back to purchase price later. I would take a look at, what is the market cap rate today? And then I've added this toggle for cap rate expansion per year. What this essentially is it's a way to make a forecast about future capital market conditions. So standard institutional practice is to increase that by 5 to 10 basis points per year. In an environment like we're in today, where interest rates are relatively high relative to where they were a couple years ago, some operators might argue that you could actually decrease your cap rate going forward. Some would argue on a historical basis, interest rates aren't actually that high, and they could go higher. And so they would like to see that cap rate still expanding. So that gives a place for you to plug in your thoughts about the current state of the world and where you think the state of the world will be by the time you exit. Again, these gold inputs here, market rent for renovated units, market rent for unrenovated units, and the average in-place rent. These are all pulling from the unit mix, but you could just make an input here if you didn't want to go through the unit mix process. In-place occupancy, again, pulling from the unit mix, year 1 vacancy, year 2 vacancy, year 3 vacancy, and stabilized going forward. Credit loss, staff and model units, mark-to-market timing. If you're using the broad stroke renovation analysis and you're scoping by building, then this gives a place to mark the unrenovated units to market over time as you're executing your business plan. Resident retention at lease renewal. This is the assumed amount of residents that are going to renew their lease. And the reason this matters is it works together with your rent growth assumptions to burn off your loss to lease, and it impacts your absorption and turnover vacancy. To the extent a property has any retail or commercial component, there's a place to make a general income assumption about that here. Other income. expense inputs per unit per year and a breakdown of a couple of those. Rent growth and expense growth assumptions, and I've included separate expense growth assumptions for insurance and taxes because those are always a sticking point. Speaking about financing, so the way that I've set up this model for right now is I have a senior acquisition loan that's used at closing for the purchase price, and that's sized off of the lesser of loan to value, amortized DSCR, and debt yield. So if you had a property that is like a lease-up scenario or a heavy value add scenario, then you would just lower these requirements for DSCR and debt yield to be these really crazy loan amount numbers. But then this project is just going to size off of the lesser of those three, which is loan to value in this scenario. And that's the loan amount that'll actually flow through and the payments that'll flow through. So that's going to give you a calculated loan to cost. And this is really low right now because I'm working on an interest reserve and working capital reserve that really dilutes this loan to cost right now, but I'm providing an update for that right now. This is your interest rate, loan constant, origination fee, loan guarantee fee, amortization period in years, the month it gets funded, the month it's paid off, any interest only period in months, your annual payment and monthly payment, both amortized and interest only, your year one DSCR and your year one debt yield. So that is the senior acquisition loan. I want to come back to over here just to make sure I haven't missed anything. Neil asked, are there other charges on the rent roll deposit outside of the amenity fee calculated somewhere? For example, utility charges, late payments, etc. So yeah, that would be included in the other income section. That would be like utility reimbursement for RUBS, or you can specify particular other income items. It's a great question. After the senior acquisition loan for a renovation scenario, you total up your renovation cost here, which those come from the sources and uses tab, and they also come from the renovation by floor plan if you choose to use that. So that all of that information is synthesized here, and then you do a loan to cost based on those renovation costs, and that'll give you your max loan amount. And your total loan draw, it'll be the lesser of your max loan amount or whatever loan proceeds you actually need to draw, which is specified in the Calc Financing tab. So loan to cost, this should be equal to loan to cost, and it is. Interest rate, loan constant, origination fee, etc. Amortization period. The funding month, this is funded, the renovation loan is funded after equity is spent. And then this is when it's paid off, the interest only period, etc. So those are like the two, I would say, acquisition or front-end loans to execute the business plan. And then I have two takeout loans, essentially. The first one, this first refinance takes out the acquisition and renovation funding. I have them built on toggles, so you can toggle them on and off for yes or no. So if it's set to no, then all this information down here is going to be zeroed out. If you set it to yes, it's going to auto-populate the information to take out those prior loans. So it's not just a takeout loan. It's sized off of LTV, DSCR, and debt yield at the time that you take it out, or at the time that it's funded. But if you did want it to just be a takeout loan to take out the other two, then you would just reduce these amounts appropriately to be equal to the total loan amount that you're taking out. Some operators like to do it that way because it shows the refinance a little bit more conservatively. You'll see this loan cash flow at refinance is this loan amount of the refinance less the payoff of the other two loans, and it's a really big amount, which means that it's a huge cash out refinance, which is going to juice the returns. So some operators like to do that because they have this view of the state of the world at that time that it's going to be really strong. They're going to execute their business plan to perfection, and they're going to have this huge cash out that they can do, and it's really accretive to the deal from a pro forma perspective. But some operators like to take it more conservatively and just say, we're just going to take out the old proceeds, get cheaper debt, and keep flowing from there. And then anything on top of that's gravy. So it just depends on how you like to do it. For the refinance, because these are now your operations and not a prior operator's operations, you can get more nuanced in the NOI for loan sizing, depending on the lender that you're working with. So I've included a toggle for that, right? You can do your forward 12 NOI, forward 6, trailing 3, etc. So that is the first refinance. The second refinance is really just more of the same, but it takes out the first refinance. Some operators, they look at a value add deal on a 15-year hold or 10-year hold or whatnot, and they want to keep their leverage high, and so they'll want a second refinance, and so that's why I've included there. So we come back to the chat here. Welcome, Neil. I spent a lot of time on this command center main inputs page because, as you can see, these are really the standard operating and financing assumptions and your general investment thesis, right? Your view of the world, your view of this asset, your view of the submarket, etc. So I really tried to centralize all of those assumptions onto this one page. So that way, you spend some time on this page, but you don't have to flip around to a bunch of other pages to really make all of those assumptions. You just make them here and you're good to go. So. After I went through the command center main inputs, I would go back to the calculation investment cash flows. I would review those historical concessions in the future development pipeline like we talked about, and I would adjust those forward concessions accordingly. I've also added optionality to have taxes be reassessed at disposition or to not have them be reassessed at disposition, and I'll show that on my investment summary cut here really quick. I'll go over this whole thing in a minute, but I just wanted to show you this chart. So this model is currently set for a 5-year hold. And you'll notice that after year 5, the NOI drops and then it continues its upward trend. And the same thing on the valuation side, it goes up and then it drops for the actual exit and then it goes up. So the reason for that is in some municipalities, they reassess taxes every year, right? Or they reassess every 2 years or every 5 years or whatnot. So if your sale year happens to fall in a year that you would expect taxes to be reassessed for the next buyer, then you're going to want to factor that into your analysis. For some operators, they can be flexible with that and try and avoid that reassessment year. That'd be ideal, right? But for some operators, it's a closed-ended fund. They have to sell by a certain year, and so they need to make real assumptions about what's going to happen. So I've included that toggle here in the calculations. So that is here, tax reassessment at disposition. It's currently set to yes. And you'll notice that if we look at the NOI per unit per year in year 6, the year after disposition, it's lower than year 5. But if you set that to no, I don't want it to be reassessed at disposition, then the NOI per unit per year is actually going to be higher than the prior NOI. And that makes sense. If you reassess your taxes the year after sale, unless you have really big rent growth to offset the tax reassessment, then it's probably going to drop. So that's what that toggle's for. After I've taken a look at the tax situation, I would then go on to take a look at the value add scenario if I'm going to do a value add deal. So before I get into that, there's quite a bit of nuance and calculation that goes into the back end of this, and I'm more than happy to go into it. But I do want to pause here, give a second to reflect. After everything that I've gone over up to this point, are there any questions that people want me to cover? Any other items that you want me to go over? Darren, yes, those are property taxes. It's not income taxes.
Maybe. Can you hear me?
Yeah.
Maybe go over you covered a lot, but the most important pieces of this model. That is a lot of information, and maybe what's something you don't need to consider as much, or the biggest important pieces of the model.
Sure. So what this model essentially boils down to is it's a way to, in a very sophisticated and professional way, look at a deal from its expected performance, and then provide that expected performance in a boiled down way to your investors and to your lenders. So the investment summary is a cut sheet that boils all of that information down for you. So I can go over the cut sheet if that would be the most helpful, or I can go over like where I would spend more time in the model if I was in here. Which one would be more helpful?
Yeah, where you some more time.
Sure. So the place that I'm probably going to spend the most time is going to be on the command center main inputs, but I'm really going to spend the most time here as I'm getting set up in a particular submarket and in a particular way of operations. Um, so from this, it depends on your source of information. I like to use CoStar or RealPage or CBRE Econometrics are all good resources that I like to use for rent growth or expense growth or some of these other separate growth assumptions. Um, RealPage and then Yardi Matrix both have really good information on um, on operating expenses. And then it's good to get information from the property manager if that's applicable or available. Good to get information from surrounding properties on how they're operating their properties. In my comps analysis page, I include a space for the operating expense ratio, which is just the percent of operating expenses as compared to the income. And the reason I include that there, which can help inform your operating expense assumptions, is if you can get that information, it's not easy to get, but if you can get it right from Yardi Matrix or from talking with property managers, etc., then that information can help inform your operating expense assumptions. So I go over all of this because um, once you've gotten set up in a market, like once you're familiar with a market and kind of how you would operate a deal, like you're going to set those assumptions here, on this page and set your growth assumptions and everything. And then you probably won't tweak this very much after that. Um, After you've kind of gotten your standard operating assumptions set up, um, yeah, I mean, I would move through those items that I talked about in the instructional sheet. And then after you've gone through all of those items, I know it seems like a lot, but really the rent roll drop and the T12 drop all synthesize the information for you automatically. So you're done with those in a matter of a couple minutes. You've got your operating assumptions set up here. You're done with those in 10 to 15 minutes. You've got your closing budget on your sources and uses, which I can go over in a second. But even that kind of gets standardized across a bunch of properties as you're set up in a market. So all these like little things, they do take a little bit to set up if it's a new market for you, etc. But if you're like set up in a market, then all of those little things are usually pretty standardized. So then where I'm probably going to spend time is Um, yeah, I mean, if it's a renovation scenario, I'll get into like the nuances of the renovations and I'd probably spend quite a bit of time in there. And then I'd be playing around with purchase price, and then I'm making an offer. The idea is to be able to screen a deal, in 15 to 60 minutes, and then, have a confident purchase price that you can then go make an offer on and proceed from there.
Very helpful. Thank you.
Yeah. So this investment summary that we briefly touched on, but not much, it provides a way to make a qualitative and quantitative analysis. That's a really great quick cut sheet, for your investors and for your lenders. The deal that I've set up in here, is this really big monster deal, 300 units. But you could take a 4-unit deal or a 50-unit deal or 20-unit deal or whatnot, and you could plug it into here and it would do just fine as well. Um, So it provides places where you can put photos of the building. It's helpful to see what you're buying. You probably know what you're buying, but the people that you're pitching to don't. So good place to show some pictures. This is a place where you can explain your business plan. This is a place where you can write up a couple quick highlights. These key metrics over here to the right are expressed on a nominal basis, per unit, and per square foot. And then a couple of other key metrics that some people like to see: the untrended return on cost, which is just your yield on your total cost basis, purchase price, soft costs, fees, etc. Trended return on cost is the same number, but just giving you, your projected operations relative to your cost, and then your exit cap rate. The trended return on cost relative to your exit cap rate is how a lot of people look at what the actual opportunity is. If this spread, is less than 75 basis points, so less than 0.75%, then it's a pretty automatic pass for everybody. This one is saying it has a 210 basis point spread or 2.1% spread, so that's usually good enough to get people excited about it. This down here is a sample investment cut sheet. So depending on how much someone is willing to invest with you, maybe that's 250,000, maybe that's 25,000, whatever. You can change this amount here, and it's going to show the distributions to that investor based on their contribution, their cash return, and then their return of capital, and then their investment metrics: IRR, multiple on equity, their ownership in the LP entity, and their percentage of the total capitalization. And again, the graphs that we talked about earlier. Okay, so that's the quick cut sheet. Like I mentioned, the next step is to get into how the value add module is set up, both the scope by building and then the scope by floor plan. Again, does anyone have any other questions before I dive into those items? Okay. So to scope by building, we come to the sources and uses on the closing tab. And we've got two sections here: capital cost for the exterior and capital cost for the interior. So for the exterior, you can use this whether you're scoping by building or scoping by floor plan. This really has nothing to do with the interior of the units. It's just the exterior of the community. So things like HVAC, sewer piping, landscaping, all that good stuff. You can specify when you start this renovation and when you finish it, and that will just spread this total amount over those months. To scope by building, this right here is currently saying renovation by unit equals off, and that's currently false. So what that means is our renovation by floor plan module is currently on. So if we wanted to scope by building instead of by floor plan, we would come to our renovation support sheet and see which units are on. So I'll go over the detail of this in a minute, but this is saying over here the percentage of these unit types that are being renovated. If these are currently more than 0, then there's some units that are being renovated by floor plan. So we would come over here, total units for each scope, and we would zero all of these out. So that's going to zero out the percentage of units that are renovated, and that'll come over to the sources and uses for the closing tab, and that'll tell us that yes, you're not renovating anything by floor plan right now, so you're good to use the interior by building module. So the way that you use this is you say, okay, for building 1, I think there's 15,000 per unit that needs to be done. For building 3, I think there's 20,000. For building 4, another 15,000, etc. And what that's doing is it's populating an assumed amount of units per building based on how many units there are in total, and then how many buildings there are in total. You can specify, how many buildings there are and how many units there are per building over here, but it's just an auto-populated thing for now. So then that'll give you a total renovation amount per building, and then you can specify when those renovations start and when they finish here, and the assumed renovation premium that you're getting for doing those. So with this module currently on, this is telling us that we have that we're doing some units by building. And so then we come to our calc investment cash flows, and we see that the unrenovated are split out from the renovated. And this is telling us that we have 39 units that we're renovating. And you can check that with your sources and uses closing right here, and it equals. So this is doing what it's supposed to. So this is the revenue side of it. The cost side of it is being calculated as a supporting exhibit down here below. And it's doing those renovations across those months that we specified back on that tab. And those are when those costs are being incurred. Now, this amount here, the 650,000, this is being capitalized in our closing budget because we've specified that we want to capitalize 100% of it at closing. If you only wanted to capitalize, 50% of it at closing or 25% of it at closing, whatever you wanted to do, you could change that here. So that is scoping by building. So I would use that if this was like my first look at the deal. You don't need to get into the nitty gritty of scoping by floor plan if it's a first pass. You're just trying to get a high level look and get comfortable with making an offer. If you get into the specifics of a deal and you think it's actually going to go through, I would certainly come through and try and look at this on a by floor plan basis. So there's a lot going on this tab, but really the meat and potatoes of it is this section here. So these are the specific renovations that you're going to do, right? Kitchen counters, washer, dryer, laminate flooring, all this good stuff. How much that's going to cost by floor plan. And then these are the project scope and value realized by doing these specific renovations. So I've included 4 different strategies in here. It's a way for an operator to standardize their renovation strategy, right? On some units, you'll do a platinum, which is going to include everything. On some units, you'll do a silver, which is going to be about half. Some it's bronze, where it's very, very little. So it allows you to specify the number of months that it's going to take to turn those units based on the strategy that you're doing and the size of the unit. The number of renovations that you can start per month. Every operator has their upper limit on capacity on what they're able to actually achieve. And so this gives you a place to make that assumption. When you want to start renovations, right? If you want to start it right after closing, you're going to set this to month 1. Maybe you want to start this 6 months out, set that to month 6, etc. How much of the rent premium that's being calculated from your unit mix is actually going to be realized based on the renovation strategy you choose to do. You could set this to 100%, right, and just make it easy. But maybe you think if we only do a bronze, we're only actually going to achieve 75% of what we're putting in our unit mix. So that gives you a place to make this assumption. And then total units for each scope. So let's say of our 2 bedrooms, we want to do 25% on silver, 50% on gold. Of our 1 bedrooms, we want to do 50% on gold, and then 25% on platinum, and then that's all we want to do. So that's going to give us the percentage of units that we're going to renovate, and that'll serve as the basis of the calculations. So all of these inputs here are really just meant to give you a place as an operator to say, this is what I think I'm going to do. Now let's go dig into the cash flows to see what that achieves. So there's a lot going on this renovation schedule tab, but the basis of it is how many units are not going to be renovated based on what you specified on that other tab, and how many units are going to be renovated. Of that, all of this synthesizes into those same labels that we saw over on the Calc Investment Cash Flow tab. So it's your in-place rent from unrenovated units and in-place rent from renovated units. This is in-place meaning like rent that's actually achieved going forward, not historical stuff. So from the unrenovated side, this module here pulls in the last rents that were signed as of the rent roll that you just dropped in. And then over here, it's essentially your lease turnover schedule. So you'll see like on this unit, for example, This is an A1, for example. The in-place rent here, and these are averages, right? It's not just one specific unit, it's the floor plan. So the averages for this floor plan were 1548.75, a year prior, and 1550, etc. There were no in-place A1s in October, October of 23. And then you have it going forward into November of 23, December of 23. And then for the other months, there were no A1s at all. So you have no income from the A1s in those months. And then you roll all of those units to market. So that's from the non-renovated side. And yeah, so then from the renovated side, essentially included down here a glorified Gantt chart for the renovation schedule. So again, we specified that we think we can do up to 8 units per month, and we're going to start those renovations in month 1. So you're going to start, 8 units, and then you're going to start another 8, and then another 8 until you max out for that floor plan, until until you're done with that specific floor plan. And that's going to be the same across the board for the whole unit mix. And then coming down here is where up above, you have your turnover schedule. And so if a unit is not under renovation yet, it's going to be its in-place rent. And then once those unit renovations are done, well, while they're under renovation, the income from those units is going to be turned off. And then once those renovations are done, it's going to roll back to market at its post renovated rent. And then this is a schedule for those renovation costs. So all of that information synthesizes to here to give you your rent from unrenovated units and then your rent from renovated units. And then all of that pulls into your calculations on the investment cash flows and gives you your pro forma. This pro forma, I think I mentioned it, but this pro forma, it is a monthly cash flow pro forma that sums up into an annual cash flow just for convenience. But the basis of it is monthly, so you can look at it annual on an annual nominal basis, an annual per unit basis, and a monthly nominal, and monthly per unit. So, yeah, after you've gone through and you've taken a look at what your renovations are going to look like, and you've taken a look at what your operations are going to look like, and you have a good idea of all of those things, then I'd be coming back to the command center and saying, okay, I have a good idea of my operations, I have a good idea of my renovations. Let's make some assumptions about exit and all that if we haven't already. And then I'm going to plug in my purchase price based on the return metrics that I want to see, which I've those are on the investment summary from like a investor cut sheet perspective, but they're also here below on the right side for convenience. So then you've got your purchase price, you've got your all-in basis, and that's pretty much all you need to go make an offer. So obviously we went through that in about an hour with me giving a lot of instruction and a lot of detail and all of that. I feel like if I was putting a deal through this model, especially just screening a deal, I'd be able to run through it in about 15 minutes, 15 to 30. Obviously, depending on the complexity of the deal and if there's any specific nuances, but this really takes my 6 years of experience in acquisitions and underwriting and asset management and tries to put that in a model for you. So that's the general presentation. Any questions that I can answer from there? Appreciate it. I'm going to throw the link for my model in the chat here. You're welcome to purchase it. Again, it's $9.95 this week. While I'm still, like I said, the model is, I'd say 99%, deal ready, ready to go, good to go. No major errors or flaws. Um, but yeah, it's $9.95 this week, and then it'll be $31.95 next week going forward, and I'll make little price adjustments as they see fit. But I'll provide free updates through the end of the year, and then if you have any specific modeling needs or any customizations that you want to make, then you're welcome to hire me as your fractional analyst. This model intended to work for all different size deals. Would it work for an 8-unit deal the same as a 300-unit deal? Yeah, absolutely. And yeah, everyone that was on this call, I have an attendance list, so I'll send you the recording individually. And then my intent, if you go to my website right now, frankly, my website is really just a landing page to give a general information about the model and everything. I've got a couple of snips in there and stuff, but I want to create a better instructional video. And so I'll take some snips from this meeting and some of my other demos, and I'll make a better instructional video that'll be on there too. Happy to. Glad to have you everyone here. It's been a really fun process. I mean, like I mentioned, I've been doing it for about 6 years. I got really big into networking about 2 years ago and met a lot of really great people, all of you included on the call, um, and really started into this venture, kind of testing the waters on if there was something there about 60 days ago, and um, just left my W-2 job this last Friday and started all of this full time this last Monday. So it's been fun. But yeah, if no one has any additional questions, you're always welcome to reach out individually. Always happy to chat. Really glad to have everyone on here. You bet.